This video is a special one. At McFie Insurance, most of the work we do is forward-thinking. We're looking at someone's current situation and saying, where would you like to be 5, 10, 15, 20 years from now, and what can be done to accomplish that goal? Today, we're going to look back and see what David from Florida did to change his financial picture 12 years ago and how that has ultimately worked out for him. David contacted us in 2012. He had some extra cash that he wanted to put in a secure place where it would earn guaranteed growth. He was 60 years old at the time and anticipating retirement, so having the funds be accessible without incurring penalties or fees was also important to him. After discussing his financial situation, we designed a policy to fit his goals. We always design each policy to fit the needs and goals of the person purchasing the insurance. These policies are valuable financial tools, and we want to make sure that they have the maximum potential for the one who will be using them. This design for David was based on his finances at the time and the goals he had. David had about $19,000 of extra cash, so we designed a whole life policy with an annual premium of $4,864, which was comfortable and affordable for him. Then we added what's called a single premium or a dump-in year one. This dump-in allowed David to put the full $19,000 into the policy right away. Straight off, instead of $19,000 sitting in his bank account, David had $17,706 in cash value that he could access if he needed it, and $328,055 of death benefit for his wife if he were to die. For those interested in the design details, we used a $250,000 term rider to increase the death benefit of the policy to allow the extra dump-in without violating MEC guidelines. The term rider could have come off the policy as early as year 7, but in David's case, it was also providing insurance he wanted to have in place until age 70, so we left it on the policy until year 10. The plan was for David to pay his annual premium of $4,864 for the next 9 years, which would cause the cash value of the policy to grow and continue adding to the death benefit amount. After year 10, the premium was reduced to $4,146. This change reflects the premium of the term rider, which was taken off the policy, which also caused the death benefit to go down by the amount of the term insurance, which was $250,000. Then, after year 14, the plan was for David to stop paying premiums. This is the point he anticipated he would be retiring at the latest, and so having premiums stop was kind of important to him. Notice that when the premium stops, the death benefit of the policy is decreased slightly. This policy is a reduced paid-up policy, which means it cannot take any more premiums, so the death benefit is set to an amount the insurance company guarantees they can pay for life. All of the policy details we've just gone over were 100% guaranteed. So when David purchased this policy back in 2012, he knew he had a solid plan he could count on. If he followed his part by paying the premiums when they were due, the insurance company would have to fulfill their part and give him the promised guarantees. A plan this clear shouldn't come with any surprises, right? Well, it turns out life itself can be somewhat of a surprise, and Hurricanes Helene and Milton were 2 of those surprises for David. With a disaster area rental property in need of repairs following the storms, David looked to his policy for assistance, and it turns out the policy had a few surprises for David as well. Looking at the guaranteed values from when he purchased the policy back in 2012, David knew he could count on $74,043 of available cash value. What he didn't know was that the policy actually had $92,618 of available cash value. This extra $18,575 was a surprise, a real nice surprise. David is also facing the possibility of needing to stop premiums on the policy a few years earlier than he had originally planned, which would mean less death benefit for the reduced paid-up policy. But the policy had another surprise. Not only has the cash value grown by more than what was guaranteed, the death benefit has also been growing. So if David stops paying premiums on his policy now, in year 12, he will have a guaranteed death benefit of $142,929 for the rest of his life. The original plan had him stopping premiums in year 15 with a guaranteed death benefit of $127,611. So being able to stop premiums 3 years earlier and have more death benefit by doing so is a very welcome surprise for David. So what is David going to do? We're not sure yet. I don't think David's sure yet. But he has options, and those options are even better than what he was originally planning. For those wondering how the death benefit and cash value in David's policy could grow to be more than what was guaranteed, and if this type of growth is typical, Here are the answers to both of those questions. David's policy had the potential to grow by more than what was guaranteed because it is a participating policy with a mutual life insurance company. Mutual companies share profits with their owners. When a policy is participating, it means the policyholder is considered a part owner of the insurance company and is therefore eligible to receive a portion of the company's profits. This is called a dividend, and David's policy has been receiving dividends for the last 11 years. David has options for how his dividend is paid. We recommend having dividends purchase paid-up insurance, which is exactly what David's policy has been doing. Each year, the dividends have been adding to the cash value and death benefit of the policy, and that's how it has grown to be more than what was guaranteed. This type of growth David's policy experienced is typical, but it varies from policy to policy based on the design and age and health of the insured. We know that policies can perform better than guaranteed. David's policy just proved that. But can there ever be surprises that go the other way, where a policy doesn't perform as well as it was guaranteed? Yes, that can happen. But the good news is that kind of surprise is entirely up to you. The only way a policy's performance can be lower than what was guaranteed is if you don't keep your portion of the agreement. A whole life insurance policy is a unilateral agreement between you and the insurance company. You are agreeing to pay a specific amount of premium for a specific amount of time, and as a result, the insurance company agrees to provide a guaranteed amount of cash value and a guaranteed amount of death benefit that will last your lifetime. If you pay less than what was agreed upon, the insurance company will have to alter what they can guarantee, and that's how a whole life insurance policy could perform lower than what was guaranteed. Some people purchase life insurance and then are surprised to learn that their premium is increasing, or their death benefit is going away, or the cash value is decreasing. It turns out none of these should be surprises, because all of these things have to be shown in the guaranteed section of the policy illustration. It's only someone who doesn't know what to look for in the guaranteed section of the illustration that would be surprised. But looking at policy illustrations can be a bit daunting. There are lots of numbers and lots of insurance language, and sometimes, even though this is technically not supposed to happen, not all the pages of an illustration are presented to someone. And if one or two key pages are missing, it would be impossible to know how the policy was guaranteed to perform. That's why we offer a policy review, where you can submit an illustration of your policy or a policy you might be interested in purchasing, and we'll review it with you, so you'll know exactly what's guaranteed, and you won't have to be surprised in a bad way. And if you're a McFie insurance client, you already know this, but when we design a policy, we are customizing it to fit your needs and your goals, so that no matter what life hands you, your policy will be there, just like David's policy was there for him. If you would like us to review or design a policy for you or someone you love or care about, contact us. Our number is 702-660-7000. Our email is team@mcfieinsurance.com.